Hello, everyone, and welcome back to the J22 Report. I'm your host, Johnnie Market. You all know that drill. Hit that like button and subscribe if you already haven't. And just for my weekend video, I want to do a couple of things that caught my eye. And you see more and more of this, which I think is more indicative of how bad the economy is. Much worse. So let's just go into a couple articles. Nothing too more generalist since about the markets since. And here's the first thing, and this is indication of the housing market and why prices need to come down. Otherwise, and they will come down. There will be a crash, and it's needed. One historic furniture chain closing after Chapter 11 bankruptcy. Now, this is a restructuring, but look at this. Company has survived for over 100 years, but it will be closing all of its stores. So, anyway, this just goes to show people can't buy homes because it's too expensive. Prices have to come down. And so let's go more. Surviving for over 100 years as a retailer takes both luck and incredible skill. Very few brands have survived that long. Lasting over 100 years requires either having products so iconic that demand persists even as tastes change, or being nimble enough to adapt to meet changing consumer needs. Founded in 1904, it literally made it through the Great Depression, two world wars, multiple times where swing dancing was inexplicably popular, the housing crash of '08, COVID, and that year when everyone is enamored with Who Let the Dogs Out. So obviously this, has survived a long time. Ultimately, vaguely blame the economy. Well, what else would you blame? If the economy was booming, this store would not be bankrupt. So yeah. Uh in theory, good news is that furniture companies did not anticipate that pulling forward demand would mean uh, a period of slower demand. Nothing about, high home prices leading to this. Uh so yeah, you can tell they're putting their spin on it now. Couple more with consumer spending more on experience than things created by market conditions. No, it's because people can't afford to buy homes, so they don't buy furniture. That's why. If you don't have a home, you don't buy furniture. Furniture chain had a proud history. So, yeah, of course, they don't really say which one. Wogan. So, yeah, this is the name. Furniture chain closing after 120 years. So, I'm just skipping because all this is like gobbledygook. I don't really. They're saying it's changing consumers. They're spending on consumers, on experiences. It's like no, they're spending more on the real thing is high home prices. That's why people can't afford homes. They're renting, so they're not buying furniture. They're not furnishing their home. They're not buying all this so their home can look cool and throw house parties. So Wogan introduced the practice of selling furniture to customers on credit and collecting installment accounts from these customers. Yeah, sure. Cons filed for Chapter 11 bankruptcy and decided to close all its stores. So, as you can tell, like most of these articles, they'll give you a fact or something, but they completely miss why it's going out of business. Not one word about the housing market. All of it is, oh, consumer changing consumer trends, whatnot. And this is why, and of course, this is the street propaganda. They say they report one fact, but then change the reason. Uh, I mean, it's pretty obvious. So anyway, let's go to the next article, and this shows that the Fed is uh gonna reverse course, and they're getting their mercenaries, which is the private sector, the mainstream media's corporate America. These are the mercenaries. So waiting till September unnecessarily increases the risk of recession. So look at this. Billy Dodd, Bloomberg economist, served as the president of Federal Reserve Bank from New York from 2009 to 2018. Chairman of the Bretton Woods Committee, has been non-executive director at US Swiss Bank. Yeah, basically he's a propagandist now. Once a Fed, always a Fed. So that's pretty much what he's doing. And okay, you can retire now, indirectly do our messaging to the public. I've been in the higher for longer camp, insisting that the Federal Reserve must hold short-term rate at the current level or higher to get inflation under control. The facts have changed, so I changed my mind. The Fed should cut, preferably at next week's policy. Yeah, no figure. They probably see what I'm seeing, and they're like probably in panic mode. Who knows? Maybe they're watching this channel. I was growing my subscribers and significantly the last couple of months, but these last 2 weeks I haven't grown. So maybe there's an unofficial gag order. Uh, they don't like truth. So anyway, for years, the president's strength of the U.S. economy suggested that the Fed wasn't doing enough to slow things down. So the government's pandemic era largest left people and businesses with plenty of cash to spend. So yeah, investments in infrastructure, semiconductors, and green transition boosted demand. No inflated asset prices. But anyway, easing financial conditions, particularly a surging stock market, increased wealthier households' prosperity to consume. Containing the resultant inflation, it seemed, would require sustained monetary tightening from the Fed. So yeah, basically, yeah, this is socialism for the rich. If you actually look at this, that's essentially what he said. Artificially boost asset prices. And of course, now most people can't afford homes. So anyway, let's keep going. Fed's effort to cool the economy are having visible effect. Granted, wealthy households are still consuming thanks to the buy-in asset price and mortgage refinance as historically long-term rates. But the rest have generally depleted what they've managed to save from the government's huge fiscal transfers, and they're feeling the impact of higher rates on their credit cards and auto loans. Housing construction has faltered as elevated borrowing costs undermine economics of building new apartment complex. Momentum generated by investment patterns is seen to be fading. So yeah, here it is: slower growth, fewer jobs. 3-month average employment rates up. Look, inflation pressures have abated significantly after a series of upside surprises early this year. Yeah, surprise. Inflation is always surprise to the up. Like, why is it all like? I mean, I know, I don't really. So yeah, the June reading coming next week. It's likely to reinforce. We already went through that. Why then are officials strongly hinting that there will be no rate cut at next week's meeting? First, the Fed doesn't want to be fooled again late last year. This time around, for second, might be waiting in order to build the broadest possible consensus. Yeah, they're trying to convince the public there's no inflation. So, uh, third, the officials don't seem particularly troubled by the risk that unemployment rate could soon breach the Somme rule threshold. Logic that rapid labor force growth rather than a rise in layoff is driving the increase in unemployment rate. So yeah, whatever, it's stupid model and rule. So let's keep historically deteriorating labor markets generate a reinforcing feedback. When jobs are hard to find, households trim spending, economy weakens, and businesses reduce investments, which leads, yeah, like we don't know that. So yeah, more stupid speak by the Fed. Look at this. This is telling. Although it might already be too late to fend off a recession by cutting rates, dawdling now unnecessarily increases the risk. So yeah, basically, yeah, here it is. The Fed's going to cut rates, and the Fed, even though it's technically not the Fed, but former Federal Reserve Chairman, let me get it right, president of the Federal Reserve Bank of New York. So whoever that is has already just told us. Of course, we're called recession deniers and every name in the book last year, but they already told us it may already be too late to fend off a recession by cutting rates. A recession's coming. Dwelling now unnecessarily increases the risk. So, although it might already be too late to fend off a recession by cutting rates, of course, they use it might, but yeah. So, anyway, that's all. Fed's going to reverse course. Here it is. Look at this. Yes, you can save too much for retirement. No, you can't. All right. So, and then this is the other thing that shows that. I mean, this I think is a longer term thing, but it's coming later this decade, early next. So don't think of course they have this. Replenish electrolytes. Let me skip this ad. Security may soon be. I could care less about what they have to say. Social Security benefits are falling short. The problem could get worse. New data estimates that Social Security benefits have lost 20% of their buying power since 2010. So, yeah, we were called crazy when we said they're just going to inflate away the value of the. Alan Greenspan said one thing like, yeah, we'll be able to fund Social Security. You might only be able to buy a pack of gum with it, but, we'll be able to finance it. High inflation is continuing to wreak havoc on older Americans' finances. It's estimated Social Security benefits lost 20% of their buying power since 2010. On average, payments for retirement workers would need to rise $4,440 per year to compensate for that lost value. Study confirms that prices older consumers are paying have outstripped cost of living adjustments. I mean, we would call it conspiracy theorists when it said they rigged the inflation numbers so they don't have to pay out Social Security numbers. But this is here it is. And this is Fox Business. This is mainstream. Benefits have risen from 2010 to 2024. Benefits have risen 58%, yet the cost of goods has risen by around 73. So yeah, inflation, that's a hidden tax. Problem may soon get worse. So yeah, I'm not really gonna read the rest because I already know this. It's gonna get worse. There's one way, either they can cut Social Security or they can inflate the cost of living so high it's like a bigger cut. I mean that's what they're doing. So more than one quarter of all non-retired investors said they would likely be forced upon to the workforce at some point due to inadequate savings if they were to retire within the next 12 months. And 19% doubt they'll ever save up enough money to retire. Americans believe they will need over 1 million to retire comfortably. So yeah, there you go. There you go. So yeah, this is something that a problem I always anticipated Social Security, but it looks like it's coming sooner than I thought. I thought it'd be a next decade problem. But yeah, this is anyway, that's all I have. Weekend, just some stuff in the news. And anyway, once again, this is not to be nothing on this video is to be construed as investment advice. Just my opinions on what's happening in the markets and on these articles. If you are to invest or say, look at financial advisor and discuss with them. So anyway, hit that like button, subscribe, and I'll see you next video.